October 29th, 2025, the Federal Reserve's cut interest rates for the second time this year. And they confirmed that another cut could be coming on December 10th. If you're a business owner or if you are a high earner and you are not moving your money right now, you could be losing $5,000, $10,000, even $50,000 by the end of this year. And here is what the news is not telling you. I'm Sabrina Michelle, an accountant, enrolled agent, as well as a CFO, and I have seen exactly how the Fed policies impact wealth at every level. And what I'm about to show you is what wealthy investors did within the first 24 hours of this announcement that most people have no idea exists. In the next 17 minutes, I'm going to explain what the Feds really did and the signal they sent to tell you that they may be printing money. Number two, how this affects your business cash, your savings, and your investment accounts. And then number three, 5 strategic moves you must do before December 10th. But first, there's one thing the Feds announced yesterday that changed everything. And it's the biggest signal we've seen in years. And if you understand what that means, you can position yourself to profit while everyone else panics. If you want weekly CFO strategy and tax optimization that protects your wealth, not just watered down information that comes from the bank, hit subscribe right now. Let's start with what actually happened. On October 29th, 2025, the Federal Reserve announced their second rate cut of 2025. They dropped the benchmark by 0.25% points. That's a quarter point, bringing it down to a range of 3.75 to 4%. So this is the second consecutive cut. The first cut happened in September, and the Fed's chair, Jerome Powell, confirmed a third cut is likely to happen December 10th. That's 3 cuts in 1 year. Now, here's where it gets interesting, and honestly, I am a little concerned. The vote wasn't unanimous. It was 10-2. 2 Federal Reserve officials disagreed. Governor Stephen Moran wanted a bigger cut, 0.5% instead of a quarter. Kansas City Federal President Jeffrey Smith didn't want to cut rates at all. This tells you something critical. Even the Feds disagree on what to do. And Jerome Powell said something that should make every business owner and investor pay attention. Jerome Powell said a further reduction in the policy rate at the December meeting is not a foregone conclusion. There are strongly differing views. Translation, they're making decisions in real time without complete consensus. But here's the biggest announcement that almost no one is talking about. The Fed just announced they're ending quantitative tightening on December 1st. And if you don't know what that means, stay with me because this is a signal that the money printing is about to turn back on. I'm explaining exactly what that means for your money in just 60 seconds. But first, you need to understand why they're doing this. Why is the Federal Reserve cutting rates now? Here's the official reason. They're trying to support the labor market and prevent a recession. Because here's what's happening in the economy. You have a labor market softening. Unemployment is rising. Number 2, small business hiring fell 7% according to Bank of America. Number 3, over 1 million federal workers were furloughed during the federal government shutdown. And number 4, both supply and demand in the labor market have dropped sharply. And if you didn't realize it, the government shutdown delayed critical economic reports. Some of these reports are the first time in 12 years. So what does the Federal Reserve do? They use alternative data to make decisions. They are essentially flying blind. Jerome Powell even admitted this in the press conference on October 29th. He said, if you are driving in the fog, you tend to slow down. Here's why they're cutting rates. They're cutting rates to make borrowing cheaper for businesses, hoping they'll hire more. They're trying to stimulate customer spending, and they're trying to prevent a potential recession. But here's what they are not telling you on CNBC, Fox Business, or Bloomberg. The announcement about ending quantitative tightening, that is Federal Reserve speak for, we are about to start printing money again. And when that happens, you, the consumer, your cash loses value through inflation. So let me show you exactly what this means. When the Feds start printing money, it creates inflation. And inflation silently destroys your purchasing power every single day. But there's a way to not just protect yourself, but to actually profit from this shift. And it starts by understanding what's about to happen to your cash in the next 60 days. So to sum up what happened with the Feds, they had their second rate cut of 2025, a potential rate cut coming in December of 2025, And they ended the quantitative tightening, which is the first step towards printing money. Now, here's what this means for your money, both the personal savings account and the business account, because there's one move that millionaires and wealthy people made within the first 24 hours of this investment, and it's called rate arbitrage. And I'm showing you exactly how to do it, even if you're not a millionaire yet. Let's talk about how the Federal Reserve rate cuts directly impact your money. When you're a business owner with $100,000 in reserves, an executive with a mortgage, or you're building wealth from scratch, the rate cuts affect you in three major ways. And understanding these three impact the difference between losing money and positioning yourself to profit. Impact number one, your savings accounts are about to pay you less. When the Federal Reserves cut rates, banks immediately lower the interest rate they pay you on your deposit. It is that fast. Right now, today, high yield savings accounts are still probably around 4% to 4.5 APY, but with each federal cut, those rates drop. After the December 10th cut, expect to see high yield savings account drop to 3.5%, even 3%. Let me show you what this means in real dollars. Say you have a savings account with $100,000 in it, right? At a 4.5 APY, you will earn $4,500 a year. With a 3.5 APY, you will earn $3,500 a year. What's the difference? $1,000. You just lost $1,000 per year. And that's just from one of the effects from rate cuts. For business owners with a large reserve, the impact is even more dramatic. Here's an example. If you have $250,000 in your business reserve, at 4.5%, you will receive $11,250 per year. But if it drops to 3.5%, you will earn $8,750 per year. That is a $2,500 difference. All right, impact number two, borrowing gets cheaper, but there is a predatory catch. Lower Fed rates means cheaper business loans, lower mortgage rates, and potentially a reduction in credit card interest. That sounds good, right? But here's the catch the banks don't want you to know. Come closer. Banks lower deposit rates immediately, but they keep loan rates high for as long as possible. They pocket the difference, and that's called net interest rate margin. According to the banking industry reports, banks have strategically locked in higher interest rates on their assets while keeping deposit rates as low as possible. What does this mean? So while your savings earns less, banks are still charging high interest rates on loans. Ultimately, they're profiting on both ends. All right, impact number three. Inflation is coming back in 2026. Here's what no one is talking about. When the Feds end quantitative tightening on December 1st and eventually start printing money again in 2026, that will create more dollars in the economy. And more dollars chasing the same goods equals inflation. Right now, inflation is running around 3% to 3.5%, but according to the economic forecast from JP Morgan and Deloitte, inflation could rise again in 2026 as the Feds inject more liquidity into the system. This means your purchasing power decrease. So the typical American household is already spending $208 more per month. That's a roughly $2,500 more per year just to maintain the same standard that they had last year. But no worries, there is a way to protect yourself from all three of these impacts and position yourself to profit. And it all starts with making 5 strategic moves in the next 30 days before December 10th rate cuts. I'm going to break down each move step by step. But first, let me tell you what's happening right now in the financial markets and why you need to act fast. According to Bank of America and Morgan Stanley, the S&P 500 is up 30% from April 2025's lows. We've doubled in price over the last 5 years. And lastly, analysts predict another 8% increase in 2026. Historically, when the Feds cut rates while markets are still high, volatility increases. Market crashes tend to happen 12 to 18 months after the rate cuts begin. The last 3 times the Fed cut rates coincided with the largest market crash in that period. Okay, let's move on to the housing markets. Mortgage rates are at their lowest in over a year, but they're not going back to 3% anytime soon. However, housing sales are expected to increase 10% in 2026 as rates drop. Getting back to what the wealthy investors did in the first 24 hours, according to BlackRock and JP Morgan research on high net worth investors' behaviors, within the first 24 hours of the Fed announcement, wealthy investors, number one, moved cash out of low yield savings account into high yield savings account before those rates dropped further. Number two, they locked in bonds, CDs at current rates. Number three, they increased equity exposure in sectors that benefited from lower rates like technology, real estate, consumer discretionary. And number four, they shifted to alternative assets like REITs and private credit. They didn't wait. They didn't hope, they moved immediately. And that's exactly what you should do too. You see the pattern here? Rate cuts sound positive on the surface, but they lower your savings returns, they create future inflation, and they increase market volatility. The wealthy understands this. They move fast to protect their money and position for profit. That's what they're doing right now. Now that you understand what is happening and why it matters, let's talk about the 5 strategic moves you need to do before December 10th. And move number 3 is the one that can save you $10,000 or more, but only if you act within the next couple of weeks. It's a 5-minute phone call that most people don't even know that they can make. Here are the 5 moves you need to make before December 10th's rate cuts. I am breaking down both business and individuals because the strategies are slightly different, but equally as important. And I want you to screenshot this section because these are the exact moves my clients are making right now to protect their 6- and 7-figure businesses. Move number 1, lock in high yield savings rates immediately. This is the most important move, and you need to do it this week, not next week, not when you find time for it. Do it this week. Right now, today, you can still lock in 4.5%, 4.25%, 4.35% with different banks. But after December 10th, the Federal Reserve cuts, it could drop to 3.5% or lower. You have less than 4 weeks to get this done. Let's do it. Here's what you need to do today. For a personal savings account, open a high yield savings account. Transfer your emergency fund, that is 3 to 6 months of your living expenses. You only keep 1 to 2 months in your regular checkings account for immediate access, but transfer the other months to your high yield savings account. For business owners, calculate 1 to 2 months of operating expenses. Keep only 1 to 2 months in your checkings account. Move everything else, your 3 to 6 months reserve, to a high yield business savings account. So what does this look like? With $100,000, a regular savings account is 0.4%. So that means you earn $400 a year. A high yield savings account, you earn 4.5%. That is $4,500 a year. So that is a difference of $4,100 that you could have access to. And then for a business account, if you have $250,000 in a business reserve, the business checking account, it could be 0.07% and you earn $175 a year. A high yield business savings account could be 4.3%, where you will earn $10,750 a year. The difference is $10,575 in which you would just be letting go. And think about it. For business owners, that is $10,575 that you're just giving away to the bank for free because you didn't act now. You have until December 10th, and after that, the rates are gone. Move number 2, refinance expensive debt, but calculate your break even first. So if you have a high interest debt, this is the window for refinance. But this is critical. You need to calculate your break-even point. Don't just refinance because the rates are lower. For my business owners, if you have a business loan or a line of credit or equipment that you're financing at 7% or higher, get a refinance quote this week. Let me give you an example. For business owners, if you have a $200,000 business loan at 8%, your current monthly payment is $1,740. Your annual interest paid is approximately $16,000. If you refinance to 6%, your new monthly payment will be $1,465. Your annual interest paid will be approximately $12,000. You are saving $275 per month, and you are saving $3,300 per year. But here's the key. Calculate your break-even point with closing costs. So what does that mean? If refinancing costs $5,000 in fees and you're saving $3,300 per year, your break-even is about 18 months. Only refinance if you are saving 1.5% points and you are keeping the loan long enough to break even. Because let's be honest, there's no prepayment penalty. For individuals with mortgages, if you are paying 7% or higher on your mortgage, this is your refinance window. Let me explain why. If you have a $400,000 mortgage at 7%, your monthly payments are around $2,661. Your annual interest paid is about $28,000. But if you refinance to 5.5%, your monthly payments will go down to $2,271. And then your annual interest paid will be approximately $22,000. That will save you $390 per month and $4,680 per year. But here's the uncomfortable truth that I need to tell you. The 3% mortgage rate during COVID was a once in a generational situation. This was an emergency monetary policy for a global pandemic. So right now at 6%, this is the lowest we've seen in over a year. Don't wait for rates to get back down to 3%. Move on what is available right now. Number 3, call your credit card companies. This move is insane, and 99% of most people do not know that they can do this. Credit card interest rates have exploded. In 2021, the APY was about 15%. Now it's 21% or higher. But here's the bank's secret that they do not advertise. You can just ask for a lower rate, and oftentimes they'll give it to you. Here's the exact script. Say, "Hi, my name is," and state your name. "I've been a customer for X amount of years. I've made my payments on time and my credit score has improved. I'm currently paying X amount percent in interest rates, and I'd like to request a lower rate. I've been offered a lower rate by another company. Can you match that or beat that?" And I'm telling you, if you have a good payment history and your credit score has improved, they will drop your rate 2 to 5% on the spot. So think about it. If you have a $10,000 credit card balance at a 24% APY, you are paying $2,400 every single year. If it drops down to 19% APY, you are paying $1,900 every year. That is a $500 difference and a savings of $500 that can be added to your bank account. And think about it, over 3 years while paying off your credit card debt, that's $1,500 that you have saved just for a 5-minute phone call. And listen, if they say no, ask them to speak with a supervisor. Be polite, but be persistent. This is your money. Do not leave any of it on the table. Number 4, accelerated tax deductibles, business expenses in 2025. Business owners, this move is specifically for you. With rates dropping and economic uncertainty increasing, here is your strategy play. Buy equipment, technology, make business investments before December 31st, 2025. Why do you ask? Section 179 of the tax code allows you to deduct up to $1.22 million in qualified equipment purchases in the year you purchased it. So this means if you are planning to purchase equipment for your business, invest in software or technology systems, buy vehicles for your business, or even upgrade your machinery or tools, do it now and get that tax deduction for this year. So what does that look like? If you are in a 24% tax bracket and you invest $50,000 in qualified equipment, your tax deduction is $50,000 and your tax savings is $12,000. So you just saved $12,000 in taxes by timing your purchases strategically. This is how wealthy business owners operate. They don't just react to tax season. They use tax law proactively to take advantage of it. And with the economic uncertainty right now, investing in your business infrastructure while getting a massive tax deduction is a smart and strategic move. Number 5, max out your retirement contributions before December 31st. I have said this in several videos. Retirement accounts are one of the best ways that you can save on taxes. This move separates wealth builders from everyone else. Before December 31st, 2025, you need to max out your retirement account contribution. Here are your 2025 limits. Your 401k contribution, if you're under 50, you can contribute up to $23,500. But if you're over 50, you can contribute up to $31,000. But if you're self-employed, you can contribute up to $69,000. Half of that is for the employee and half of that is for the employer. IRA contributions, traditional IRAs. For traditional IRAs, your tax deduction is now, but you're taxed during retirement. For a Roth IRA, there's no deduction now, but you are tax-free when you withdraw the money during your retirement. And your contribution limit is up to $7,000 if you're under 50 and $8,000 if you're over 50. So what does this all look like? If you are in the 24% tax bracket and you max out your 401k at $23,500, you will save $5,640. That is money in your pocket and not to the IRS. Your money will grow tax deferred or tax free, compounding for decades. And this is how the wealth stay wealthy. They use every tax law to their advantage. And this is just scratching the surface of it. So if you are self-employed, that $69,000 contribution is a massive wealth builder as well as a tax saving opportunity. Let's recap the 5 strategies in under 30 seconds. Number 1, lock in a high yield savings account. Look for something over 4% APY. Refinance expensive debt only if the break even makes sense. Call your credit card company and ask them for a lower interest rate. Accelerate business expenses into 2025 and then max out your retirement account by December 31st. These are the exact moves wealthy investors are doing, as well as my clients. The question is, will you join them? Okay, let's pause for a second. If you are still watching, you are not like most people. Most people would rather stay comfortable and lose money than to do something uncomfortable to protect their wealth. But you're different. You're here because you actually care about building wealth and growing your business. So do me a favor, drop a comment right now and tell me, are you a business owner or are you building personal wealth? And let me know which strategy you're working on first. I read every comment and use them for future videos so that I can serve you better. Now, let me tell you what's coming in December and why you need to prepare for what's happening next. December 10th, 2025, that is the next Federal Reserve meeting. And based on everything that we know from the Federal Reserve's communication, as well as the economic forecast, here is what is likely to happen. The Fed is expected to cut rates by another 0.25%. This will bring the benchmark down to 3.5% to 3.7%. But here's what's more important than the rate cut itself. The Fed is ending quantitative tightening on December 1st. Let me explain what that means in simple terms because this is critical. Imagine the economy as a swimming pool. When the economy crashed, the Fed fills that pool up with water, aka money. So everyone has enough room to swim. Over time, that water evaporates. So the Fed has to decide, are they going to top it off or are they going to let it dry up? Quantitative tightening is letting the water evaporate, which means removing money from the economy. Ending quantitative tightening means stopping the evaporation, which means you keep supplying the economy with money. Quantitative easing means that you are printing money, which equates to you are adding more water or adding more money into the economy. So right now, the Feds are moving from step 1 to step 2. And according to the economic experts and FedWatch, by mid-2026, they're likely to be at step 3. That's printing money. And when they start printing money again, this is what happens. Inflation comes back. More money, more dollars circulating equals higher prices. Asset prices rise on your stocks, your real estate, and your cryptocurrency. And your cash loses purchasing power. So your dollar buys less. This is why locking in a high yield savings account now matters. And this is also why moving strategically for the next 30 days matters, because by the end of 2026, the economic landscape will look completely different. So I created this action timeline for you. Let's go through it. By November 15th, you should have opened a high yield savings account for your business account and your personal account. You are transferring your cash reserves and you have locked in a current rate of 4% or above. By December 1st, you have your refinance quote on your business loan as well as your mortgage. You've called your credit card companies and asked for a reduced rate. And you've started planning your year-end business purchases. By December 10th, you have completed your strategic refinance federal cut before the third Fed rate cut, and you have finalized high-yield account transfers. By December 31st, you have maxed out your retirement account contribution. You have completed your Section 179 equipment purchase, and you have finished your year-end tax planning with your CPA, accountant, or EA. So 2026 and beyond, you are monitoring the Fed's policy towards money printing, and you are adjusting and strategizing your investments for an inflationary environment, and you are staying consistent with your wealth building system. This is your roadmap, and this is your battle plan. So let's recap what we covered. What happened? The Feds cut rates for a second time in 2025. and they're expected to cut rates again December 10th. And quantitative tightening is ending on December 1st. How will this affect you? Your savings rates are dropping, so that means you're losing hundreds to hundreds of thousands of dollars. Borrowing is getting cheaper, but bank loan rates are still high, and inflation is expected to come back in 2026. So what are you going to do about it? Number one, you are locking in high yield savings account. Look for something that is 4% or higher. Number two, you are refinancing your expensive debt. Number three, you are calling your credit card company and asking for a lower interest rate. Number four, accelerating your business expenses, specifically for Section 179, qualified equipment. And number five, you are maxing out your retirement account to save thousands of dollars in taxes and putting money towards your future. If you make these moves before December 10th, you are in a position to protect your wealth while everyone else is scrambling and reacting emotionally. No more leaving thousands of dollars on the table, and no more falling victim to Fed policy or economic news. This is how you build generational wealth, not by reacting emotionally to economic news, but by moving strategically while the opportunity presents itself. So, if you don't remember anything else, remember this: master your money, build your legacy, and lead with intention, because the Federal Reserve is cutting rates whether you are ready for it or not. And the question is, will you be in a position to profit from this shift, or will you be behind and losing money every single day? The ball is in your court. It's your move. If this breakdown helps you understand what is really happening with your money and the strategic moves that you need to make right now, hit that like button. It helps more business owners and high earners discover content just like this. And please subscribe, because every single week I am dropping business strategy content, motivational content for CEOs, as well as building wealth in your business that actually moves the needle. So drop a comment right now. Let me know which move you are working on. If you're an individual, let me know if you found a high yield savings account. I would love to hear from you. I respond to all the comments. And also, I've linked exact high yield savings accounts I personally use, refinancing resources, and my CFO services in the description below. Now, these moves protect you from the Fed rate cuts, but these major tax changes coming in 2026, they will impact business owners and high earners in a major way. Check out my next video about the big beautiful bill and the tax changes that are dropping in 2026, and get an accountant and EA's perspective. As always, I am Sabrina Michelle, and remember, master your money, build your legacy, and lead with intention. All right, I'll see you next time.